Hi everyone, my name is Daifung Ngo Liam. I'm the current student of the online part-time Master of Liberal Arts Data Science at Harvard Business School, Harvard University. So today I will present to you my project of predicting the market movements and building smart portfolios with machine learning, deep learning, reinforcement learning for the 5 major Canadian banks. For the course, CSCI S-278 Applied Quantitative Finance and Machine Learning at Harvard Extension School, and this coursework is instructed by Dr. Mark Antonio Alwater, PhD, in summer 2025. So my project focuses on the evaluating the return potential and risk-adjusted performance of the 5 major Canadian banks, including Royal Bank of Canada, RBC, Toronto Dominion Bank, TD, Bank of Nova Scotia, or in short, Scotiabank, Bank of Montreal, or BMO, Canadian Imperial Bank of Commerce, CIBC. These banks are systematically important to Canada's financial system, represent diverse operational strategies, and are well-traded equities with ample historical data. I could see that their economic significance make them ideal for me studying equity momentum, factor modeling, and machine learning-based prediction. So I began with a set of machine learning models, including the random forest classifiers and predictors, and expanded to ensembling learning architectures that includes not only random forest, but also logistic regression and support vector classifier, or SVC. I then applied a voting mechanism where a stock was classified as outperforming or underperforming if at least one model predicted positively, making the ensemble less conservative and increasing signal sensitivity. And as you can see that the linear models I would apply would also include the bridge and lasso. And I also enhance my model into the capabilities of reinforcement learning for the portfolio allocation. So talking about the price trend analysis generally, based on my report, the RBC illustrates the strongest price growth, rising from $45 to over $170, clearly outperforming its peers. Meanwhile, the reports in my documentation also demonstrate that the BMO also shows significant appreciation, especially post 2020, with prices exceeding $140 in 2024. Furthermore, the TD Bank follows closely behind BMO in terms of price growth, maintaining a relatively consistent upward trajectory. And lastly, I also observed that the Bank of Nova Scotia and CBC show more volatile and flat in price performance over the decade, with Scotiabank clearly underperforming. Therefore, my preliminary analysis signals that the COVID-19 pandemic and its crash in early 2020 is evident across all 5 biggest Canadian banks, followed by a strong rebound, especially for the Royal Bank and BMO. Now I will analyze the daily return behaviors. The daily returns plots that you are seeing right now show all banks experience sharp spikes in volatility during market shocks, notably March 2020 with the COVID crash. Their volatility has remained relatively stable post 2021, but occasional high return days with positive and negative figures still appear, unfortunately. And I observed that the return series for all 5 banks are highly correlated, reflecting the interconnectedness of Canadian banking performance with macroeconomic trends. So talking about the summary statistic that I have analyzed earlier, I can see that the Royal Bank of Canada leads in average daily return and shows lower volatility, fortunately enough, supporting its strong price performance. But on the other hand, the CIBC and BMO exhibit a higher volatility with the standard in terms of the standard deviation, leading to larger swings in both directions. Meanwhile, it seems to me that the Scotiabank is the most conservative performer with the lowest average return and substantial drawdowns, making it less attractive from a growth perspective. So I believe that all of the five Canadian banks demonstrate fat tail behavior with high max gains and losses, which is consistent with financial time series exhibiting heavy tails and leptokurtosis. So my analysis results clearly show to me that there is risk and return trade-off. The RBC offers the best risk-adjusted return with the highest average return and lowest volatility among the five banks. Beside that, CIBC offers high returns, but at the cost of higher volatility, suggesting greater risk for the investors, especially those new with a limited budget and investment frequency. For Scotiabank, it seems less rewarding despite having comparable volatility to peers. So it raises the questions about its growth strategy or exposure to macro shocks. So in my summary, the Royal Bank of Canada and BMO shows that they are likely more attractive for long-term investors seeking growth and stability. Meanwhile, TD is second best, that provides a moderate return risk profile. And the CIBC could be suitable as well for the risk-tolerant investors like me seeking higher upside. Unfortunately, the Scotiabank, from my analysis, may require more of my caution due to persistent underperformance and volatile downside risk. So if you look at the histogram daily returns that I'm showing here, it shows that all banks have bell-shaped distributions centered around the zeros, and they exhibit slight left skewness with more pronounced negative returns than positive extremes. The CIBC shows the widest tail, reinforcing its higher downside risk from the summary stats. As observed from these plots, daily returns of Canadian banks are approximately normally distributed, validating my assumptions for basic modeling like CAPM and linear regression that I would do later on through through all of my pipelines that I would build later. Although the risk management must account for the tail risk. So let's look at the correlation heat map here. All pairwise correlations are very high, ranging from 0.73 to 0.8. The BMO and the CIBC at around 0.8, and BMO and the Scotiabank at around 0.79, show their strongest relationship. Meanwhile, the CIBC and TD at about 0.73 is slightly weaker, possibly due to the differences in risk exposures or operational scale. So my insights indicate that there was low diversification potential among these banks, including non-bank and global assets that might improve risk-adjusted returns. So as I observe from the scatter matrices of returns, all scatter plots reveal strong positive linear relationships between all pairs of banks, and the density of points around the diagonal in each pairwise plot confirms high correlation. Also, even the KD plots on the diagonals also support normal-like distribution. In short, I can extract an insight that the Canadian banks move together in the market, suggesting exposure to common macroeconomic or industry-wide factors. Therefore, I can conclude that these insights are useful for my later portfolio diversification analysis for now. So let's switch our attention to the box plot of daily returns. Here's another outlook of analysis. I figure out that the box plots confirm symmetry and reveal many outliers. The Royal Bank and BMO have slightly wider interquartile ranges, reflecting more variation in their daily performance. Each bank distribution is tightly centered around zero, but the tails extend widely and consistent with fat tail distribution. The visual representation of this box plot imposes a potential risk that despite low median returns, there are still significant positive or negative deviations. So by looking at the autocorrelation plots, the ACF plot shows significant autocorrelation at lag zero, as I expected, but very low autocorrelation at all other lags. Besides, most values beyond lag 1 fall within the confidence intervals. This implies that daily returns are weakly autocorrelated or even nearly zeroly uncorrelated. Therefore, this supports the efficient market hypothesis, suggesting me to confirm that past daily returns do not predict future returns, at least in the short term. So here I would do preliminary LSCM forecasting analysis for the 5 Canadian banks for the period of 2014 until 2024. And my general observations indicate that all banks exhibit strong predictive performance with the LSCM. As the predicted lines closely follow the actual prices, as you see, these alignments suggest that the models effectively capture short-term temporal dependencies in stock price sequences, where I trained the model using a rolling window of about 60 days and tested on the final 20% of data of roughly 2 years. Now I will analyze the individual banks' performance. For the Royal Bank of Canada, it shows the best performance as the model captured long-term upward momentum with very low deviation. So when I tracked the pattern, I found that both short-term corrections and rebounds are well modeled. This illustrates that Royal Banks of Canada's stability and consistent trend made it ideal for the RCM forecasting. For the TD Bank, there's clearly high volatility as the model predicted direction well, but underperformed in magnitude during rapid price jumps. There are also challenging zones where significant deviation occurred in later years when volatility increased. So for the Scotiabank, there's a smooth tracking as predicted series aligns very closely with actual prices, but there is moderate variance that slight smoothing was noticed, but trend detection is reliable considerably. For the Bank of Montreal, the BMO, there's high fit accuracy that one of the top performers alongside RBC and Scotiabank. I would consider it as strength that it captured both short-term and long-term trends with tight error margins. For the CIBC, there's volatility captured here as the model reasonably followed the swings, but underreacted to sharp price changes. I also observed deviation as some short-term peaks were smooth, and due to the model's preference for trend continuity. These are model strengths and limitations that I would also need to put into consideration as well. Regarding strength, When conducting nonlinear modeling, I see that LSTM is adept at capturing lag dependencies and nonlinear price movements. It has shown sequential memory, which is ideal for time series with seasonality or repeating patterns like the banking cycles. Its predictions are relatively smooth, which help remove noise while preserving trends. Um, However, there are certainly limitations as well. I observe over-smoothing as LSTM tends to flatten out rapid swings due to training loss minimization, EMSC, when data sensitivity aspects of scaling, window size, and test horizon significantly impact the results. Therefore, LSTM does not offer interpretable coefficients like linear models, particularly the CAPM. In short, I can conclude that the LSTM model successfully demonstrated the ability to forecast stock price movement trends across 5 major Canadian banks. The RBC, BMO, and Scotiabank had the most reliable forecasts with minimal tracking errors, making them strong candidates for future momentum or signal-based trading strategies. While TD and CIBC show slightly less precision, the models still perform within acceptable error ranges. Still, there's some future work that I could include, like comparing against RBMR, GRU, or transformer models. Furthermore, I find that incorporating macroeconomic indicators like interest rates can increase explainability and model performance. I would strongly recommend it with testing on smaller data unit like minute or even hourly data for short-term traders, and consider adding rolling retraining and online learning capabilities. So let's conduct an analysis of scale adjusted close price distributions with the min-max scaler. Here I apply the min-max scaling to normalize each bank's price data between 0 and 1, which is a standard pre-processing step for machine learning models like LSTM. This helps me to preserve relative volatility and trends while removing absolute price scale differences. Here are some of my observations from the 5 banks. The BMO distribution is multimodal, with multiple visible peaks, suggesting BMO experienced several distinct pricing regimes over the last 10 years. Its price range is fairly well spread, with substantial activities across the 0.1 and 0.9 interval. Therefore, this indicates non-stationarity and long-term market regimes challenges. For the Scotiabank, it has a standard and moderately uniform distribution, peaking around 0.4 and 0.5, which suggests that Scotiabank's price stay within a tight range for most of the decade, but with a few movements toward higher or lower extremes. From another angle of view, the relatively balanced distribution makes Scotiabank predictable for time series models. Meanwhile, CIBC has a less skewed distribution, with many prices clustered at lower values under 0.3, which suggests longer periods of lower prices, or less recovery in later years. Besides, I found that the spread into the upper range was less frequent, indicating lower growth compared to the peers. The RBC also experienced a multimodal with visible spikes around 0.05 and 0.25, 0.5, and 0.65. Like BMO, RBC's price progression was dynamic, capturing growth spurts and pullbacks over the years. Therefore, I have more confidence to state that RBC's rich price dynamics likely help LCM models achieve a strong forecast. The TD has a right skew distribution, with the majority of prices clustered in 0.6 and 0.9 range. This suggests a consistent upward growth for a longer period span in higher price zones. On the other hand, unlike on CBC, TD spend less time in the low range, highlighting resilience and growth. In short, I can affirm that multimodal or skew distributions indicate market direction shifts or long-run trends that can be exploited by sequence model like STM. Besides, you can see that openly distributed series like the structural banks suggest near reverting or stable behavior, favoring simpler models like ARIMA. So these distributions also highlight the importance of rescaling models sensitive to magnitude, especially with the RNX data. So here are the two most popular stationarity tests I will implement. The ADF augmented Dickey Fuller with the whole null hypothesis stating that the series has a unit root or non-stationary. If the p-value is lower than 0.05, I will reject the null hypothesis and conclude stationarity. Another test is a KPSS with the null hypothesis stating that the series is stationary. If the p-value is lower than 0.05, I would reject the null hypothesis and conclude non-stationarity. As I observed, I found that all 5 series failed the ADF test, as the ADF p-values are very high, so I failed to reject the null hypothesis here. Therefore, they are likely non-stationary. Also, as all 5 series failed the KPSS test, shown by the KPSS statistic that are far above critical values, with p-values lower than 0.01, I reject the null hypothesis as they are non-stationary. Moreover, these adjusted close price series are trend-driven and non-stationary, as is common with raw stock prices. So I can affirm that both tests confirm this. I also need to proceed with modeling like a reamer, VR, or deep learning later on, so I have to double sure that stationarity must be imposed with other techniques like first differencing to transform prices into returns of prices differences, or log differencing, which is better if modeling percentage changes, or min-max scaling for common data standardization. Then I will rerun ADF and KPSS on the difference or log return series to check if stationarity is achieved. So let's conduct another stationarity analysis of scale adjusted of close prices for the same period after min-max scaling. As observed, all 5 banks scale price series as non-stationary. This is confirmed by both ADF and KPSS. Therefore, the ADF fails to reject the null hypothesis of non-stationarity. Also, KPSS test rejects the null of stationarity, reinforcing my conclusion. However, I find that the min-max scalar does not induce stationarity. Scaling adjusts the range 0 to 1, but does not remove trends or unit roots. As per my visual inspections of the price trends, it previously confirmed structural growth patterns, especially in C, BMO, and TD, contributing to non-stationarity. Therefore, instead, log transformation or differencing may be required as the data is non-stationary. Techniques like first order differencing, log differencing, detrending with moving averages, or regression residuals should be explored prior to training models that assume stationarity, such as RY.TO. Another point to mention that LSTM handles non-stationary data well. It is basically unlike statistical models. LSTM-based neutral nets can capture long-term dependencies and trends, even when the series is non-stationary, which I find out it aligns with the accurate forecast observed in earlier LSTM blocks. In short, my analysis confirms that the original time series are trend-dominated and non-stationary, even after scaling. If you're using traditional statistical models like ARIMA or GOSH, considering transformation in differencing. However, for deep learning models like RCM, retaining the original structure post-scaling is acceptable and can even be beneficial from a later sequence model if applicable. Here's my analysis of the seasonal decompose. As you observe here, this means that the trend reflects long-term growth, while seasonality represents periodic fluctuations like monthly patterns, and residuals capture random fluctuation not explained by trend or seasonality. I will explain the trend analysis for the period as follows. RBC and BMO have the strongest upward trends, reflecting long-term price appreciation and likely investor confidence. TD and CFBC show moderate trend growth, especially after 2020. However, Scotiabank display a flat trend, suggesting relatively slower long-term performance. Therefore, I conclude that banks like RBC and BMO exhibit robust structural momentum, which aligns with their strong market capitalization and earning history. Now I will analyze the seasonal component. All the 5 banks exhibit strong and consistent seasonal patterns with a 12-month cycle. Their seasonality amplitude is narrow, between 0.98 to 1.02, meaning seasonal fluctuations are modest but systematic. I also observed that peaks often occur late in Q1 or early Q2, and troughs appear in late Q3 and or early Q4, likely reflecting fiscal effects, dividend payout cycles, institutional portfolio rebalancing, and earnings season dynamics. These are proven as TD, RBC, and Scotiabank have sharp seasonal peaks around March and May, possibly tied to the post-earning or dividend payout strength. Regarding the residual component, the residuals, which are random error not explained by trend or seasonal, are fairly small and stable. Besides, most residual points hover around the route 0, indicating that around +1, indicating that random fluctuations are minor compared to trend and seasonality. But there is one exception, that some larger deviation in 2020 and 2021, likely due to COVID-19 market shocks. At this point, I can come up with some strategic implications. For forecasting or portfolio modeling, I can use seasonal adjustment when forecasting short-term returns. BMO and RBC may serve as my anchor investment for long-term portfolios. I will also consider the seasonalizing data if using regression or machine learning for monthly predictions. For trading strategies, I can see that mean reversion or pairs trading may benefit from knowing seasonal peaks and troughs. I will also have to assess the timing entries and insist I will buy in trough months and sell in peak months. As these actions could improve my tactical asset allocation. So with the techniques of the fractal differencing, I can observe a few things. I apply fractional differencing as I aim to transform the non-stationary time series into stationary ones while retaining long-term memory, which is crucial for models like ARIMA or machine learning pipelines that require stationarity. Standard differencing like D equal to 1, remote but livable long-term memory. On the other hand, fractional differencing with D lower than 1 preserve long-range dependencies, important for financial forecasting. I can observe Scotiabank is clearly stationary after fractional differencing with p-value lower than 0.01. Meanwhile, TD is marginally stationary with p equal to plus 0.005, just hitting the 5% critical value threshold. Also, the BMO is borderline and stationary with p-value at 0.077, just outside 5% significance. Lastly, CIBC and Royal Bank of Canada remains non-stationary post-differencing. Based on the plots, each display the fractionally different series using a three-term approximation in D equal to 0.92. I can notice that variance and volatility increased rarely after 2020, notably during and after COVID-19 crisis. Thankfully, difference series maintain the overall shape of volatility spikes, but reduce longer-term trends. Fortunately enough, their different series have a more mean reverting behavior, indicating improved stationarity in some banks. I also see that the Scotiabank is now suitable for a Rimmer or Gauge model. TD and BMO might be acceptable depending on the tolerance level for the p-value. However, RBC and CBC need further differencing or alternative transformations such as lot differencing or power transforms. In short, fractional differencing at D equal to 0.92 proves effective in partially stabilizing financial time series. I can state that only Scotiabank and marginally TD achieved clear statistical stationarity. Still, this technique helps me to balance the trade-off between stationarity and memory retention, making it well suited for forecasting tasks in financial applications. So now I will conduct the lasso regression in the dendrogram. And this is my analysis of hierarchical clustering for feature selection. I use hierarchical clustering on standardized engineered features derived from Canadian Bank OHLCB data to export a cluster map, heat map with dendrogram, to analyze feature correlation structure. The heat map matrix will show the pairwise Pearson correlation between features. The hierarchical clustering will group the it will group the features with similar correlation profiles into clusters. The color map by blue showing that darker blue is equal to higher positive correlation and vice versa. These are highly correlated clusters, including F4, F5, F6, F8, and F3, which are tightly grouped and strongly correlated. These are the all volume-based matrices. F4 represents the volume change, F5 volume change over 50 days, F6 volume percent change, F8 volume versus 200-day MA, F3 which is the log volume. This suggests redundancy among these features. I can select only one or two to reduce multicollinearity. Besides, these are moderately related pair like F1 and F2, close open return and open versus reverse close return, are somewhat isolated but closely clustered, indicating they share similar return behavior. These are also unique features like F9, which is the close versus 50-day EMA, and F10, which is the Z-score versus of the close, which form a separate subcluster reflecting trend following behaviors and have low correlation with volume related features. Regarding the dendrogram, my hierarchical tree of features, my dendrogram visualizes how features cluster based on their correlation distance. The shorter linkage, which is shown by the horizontal lines, imply more similar features. I can observe that the F4 and F6 are the most similar pair, choice at a very short distance, which is the volume difference and the volume percent change. F5, F8, and F3 successively join that cluster, forming the volume cluster. F1, F2, and F9 are less similar to volume features and remain in separate branches longer. And lastly, F10 joins later, suggesting it captures normalized trend signals orthogonal to raw volume and price data. Here's my lasso regression pipeline for the 5 banks. The F10 disappeared for alpha at 0.08. That could be because for all 5 and 8 banks, the top coefficient F10 is the Z-score of close appears as the dominant predictor when Y equal to close and alpha is low at 0.01 and moderate 2. However, when predicting percentage change with Y equal to percent change with alpha 0.08, F10 has no significant influence, and all coefficients are shrunk towards 0. By looking at the plots, at alpha at 0.01 or 2 with close, there are excellent linear patterns, suggesting F10 is linearly related to close. I can observe that all predictions are highly accurate with tight diagonal scatter. However, for alpha at 0.08 with percent change, they are wide scattered, so lasso is unable to find strong predictors. Feature importance nearly vanish, confirming the poor correlation between engineered features and next day returns. Here's my PCA on the financials. Here I perform principal component analysis, PCA, on normalized financial data up for 5 Canadian banks using key financial features. Total revenue, net income, EBITDA, interest and expense. Due to the availability, the final PCA input had 20 observations with 4 years and 5 banks. 3 features from safe columns that were presented for each bank. And the curve shows PC1 explain roughly 63% of the variance. PC1 and PC2 explain more than 95%. PC1, PC2, and PC3 explain nearly 100%. Actually, I need only 2 components to retain at least 95% of the total variance in my dataset. With dimensionality reduction, I can reduce my 3D financial feature space to just 2 components without losing significant information. The model simplification is obvious, as models using these 2 principal components can be more stable, generalize better. I can see that the first principal component likely reflects general scale bank, total revenue by net income dominance, while the second may capture efficiency or leverage nuances. So here's my rich regression on lag features for the 5 banks. I use rich regression with lag price features, lag 1 to lag 5, to predict the daily closing price of Canadian bank stocks. As per my plots, all predicted lines follow actual lines closely, indicating which is capturing the temporal dynamics well. For all banks, especially Scotiabank, CIBC, and RBC, the prediction curves nearly overlap with actual prices, confirming the high R-squared score approximately 0.97 to 0.98. Some details are noteworthy that TD had more short-term price fluctuations in recent years, which the model captured with slight lag, hence lower elsewhere. Moreover, BMO and obviously show minor deviations of peaks and valleys, suggesting non-linearities that which can't fully model. I find that the ratio regression worked well here as its lag features lag 1 to lag 5 provide recent historical price context, which is a natural fit for financial time series. Furthermore, the regression with L2 regularization controls overfitting, especially when lag features are correlated. And time series split preserves chronological integrity, avoiding data leakage. In short, my rich regression setup is effective, especially for Scotiabank and CIBC. The strong R-square values, a tight fit in prediction plots validate my lag-based futures and modeling strategy. Slightly weaker results for TD suggest potential value in modeling returns or volatility rather than broad prices. So let's talk about the single and multiple linear regressions I conducted. My goal of this modeling exercise is to understand and predict the adjusted closing price of TD using other major bank stocks as predictors, particularly RBC in a simple linear regression um, and other banks that in a and obviously Scotiabank, BMO, and CIBC in a multiple linear regression. My model aims to uncover the strength of the code movement among Canada's big five banks, assess the explanatory power of peer institutions on TD's price, and evaluate whether a multivariate model improves predicted performance. Additionally, my analysis highlights violation of regression assumptions and informs the next steps of building more robust, time-aware financial models. So about the simple linear regression, TD and RBC, with the elsewhere at 63.2% of TD's price variation is planned by RBC's price. With the given intercept and coefficient, the model suggests that for every $1 increase in RBC, TD increased by 36 Canadian dollars. I find that the fit moderate as over 1/3 of TD's movement is left unexplained. But there are issues to consider further. The Durbin-Watson is 0.01, which is extremely low, causing severe positive autocorrelation. Residuals are not white noise, implying model misspecification. A Chalk-Berer test is significant is residuals are not normally distributed. Also, the SLR misses complexity by relying on a single predictor. So how about the multiple linear regression of TD versus the four other banks? With the elsewhere at this value, 95.6% of the TD's price variance is explained by the four other banks. All predictors are statistically significant, with p-value lower than 0.001. Coefficients are also what we need to consider as well, which shows the impact on TD. 3 out of the 4 banks, except the Scotiabank, showed a positive correlation. My model fits TD stock very well, almost all variation is explained. However, the sign of their Scotiabank coefficient being negative may indicate multicollinearity between features or economics of settings effects. For example, TD gains when search rank drops. Therefore, I have to diagnose further if multicollinearity is true. The condition number is about 1340, which shows potential multicollinearity very likely. Also, W-Watson is 0.034, which shows severe autocorrelation, a red flag in time series. Looking at the chart of TD actual versus SLR and MLR predictions, the SLR tracks general trend but lags behind or overshoots in volatile regions. The performance underperforms in 2023-2025 range, which shows model rigidity. On the other hand, the MLR follows TD closely at the beginning, but diverges upward post 2023, which suggests overfitting or unaccounted non-stationarity in relationships. Another point to mention that the actual TD price flattens while MLR keeps rising. Switching to the MLR residual plot with predicted versus residuals, non-random scatter suggesting strong structure and clustering. However, residuals fan out and curve, so heteros skedasticity and nonlinearity present. Also, several clusters show persistent bias, which indicates systematic prediction error. Therefore, the model isolates whereas assumption errors are not homoscedastic constant variance, and residuals show non-zero mean over intervals. This suggests that I need to use time series models like ARIMA and BAR on nonlinear regularized models with which less so distribution like I did earlier. My objective here is to further that I also conducted an other analysis to predict the trusted closing prices of the other banks, but I will not mention here for now. I could switch to the next test that I have conducted to set the tone. So in my conclusion, my FLR model clearly outperforms the SLR in terms of predictive accuracy and model fit. It captures more than 95% of the variance in the RPC price compared to just 63% using TD alone. However, the residual diagnostics raised red flags. The presence of heteroscedasticity, zero autocorrelation, and potential multicollinearity all suggest that the current linear framework may be insufficient. The RBC's price is likely influenced by additional nonlinear time-dependent or macroeconomic factors not currently included in my model. To address these limitations, future work should consider using time series model like ARIMA or VAR, regularized regression like RY.TO or LASSO to mitigate multicollinearity or even nonlinear methods such as distributions or neural networks to better capture complex market behavior. Here I would try to test the heteroscedasticity with a transform price to stabilize variance by using the Borber's standard errors. Here I use the Pagan test, which to address the heteroscedasticity identified in my earlier regression models. I explore two remediation strategies, applying robust standard errors using wide HC0 correction and applying log transformation to stabilize the variance. The goal was to ensure an valid inference and meet the assumption required for reliable regression analysis. So in option 1, um, I have I apply heteroscedastic robust set errors using the HC0 correction, which adjusts the set errors without altering the coefficient themselves. For my SRR predicting RBC's price from TD's price, the R square remained at 0.632, indicating that TD alone explains about 63% of RBC's price variance. After applying robust set errors, the T-stat for TD rose to 67.278 with a p-value less than 0.001, confirming a statistically significant relationship. This correction is particularly important given that prior tests, such as the Broich-Pagan test, had flagged heteroscedasticity in the residuals, with robust standard errors in place. The inference is now considered valid despite the model's violation of homoscedasticity. For the for the MLR model, which includes the 4 other banks as predictors, the elsewhere remains strong at 0.956. All predictors were statistically significant with p-values below 0.001. However, the Scotiabank variable retained a large negative coefficient, which raises concern. This could be a result of multicollinearity. A scenario where predictors are highly correlated with each other, or a structural mean reversion effect where Scotiabank and RBC move in opposite directions during certain market conditions. The condition number for this model was 1,340, which exceeds the threshold of 1,000 commonly cited as a warning sign for the multicollinearity. This reinforces the need for caution when interpreting individual coefficients in the MLR. In option 2, I experimented with log transforming the response in predictor variables to stabilize variance and potentially eliminate heteroscedasticity. However, my log transform model did not improve this situation. The p-values for the log transform SRR and MLR remain extremely low, like about 0, respectively, indicating that heteroscedasticity likely persists. This suggests that variance stabilization through log transformation is not effective in this case, possibly because the underlying relationships in the data are nonlinear or influenced by macroeconomic factors, not addressed by simple transformations. In summary, robust standard errors via White's HC0 correction proved to be the most effective and appropriate remedy. They allow me to retain the original model structure while ensuring that inference remains statistically valid even in the presence of heteroscedasticity. Moving forward, I will rely on the robust curve results with the curve tie of HC0 for all coefficient significance testing and confidence intervals. This approach is both practical and statistically sound, especially when working with financial data that often violate the ideal conditions of classical linear models. While multicollinearity in the MLR model remains a potential concern, the robust standard error framework provides a reliable foundation for further modeling and diagnostics. Here I would do check on for the multicollinearity that the two with the TD and BMO shows a very high multicollinearity, and the Scotiabank MCM shows only moderate multicollinearity. And as you see here, the SLR Royal Bank versus TD's p-value is very low, at nearly zero, indicating strong evidence of heteroscedasticity. Meanwhile, MLR p-value is about 0.05, suggesting no evidence of heteroscedasticity. Therefore, my ML model on returns is statistically sound in terms of residual variance, so there is no need for robust errors. However, my SR model is still heteroscedastic, even on returns. Standard errors and inference may be unreliable. Next, I would conduct a work forward. So in my model approach, daily log returns were computed using the formula numpy.log data divided by datasheet1, and I would chop any unknown values. This is a standard technique in financial modeling because log returns are additive over time, and it could better capture the effects of compounding. Unlike simple percentage returns, log returns offer mathematical advantages that make them especially useful in regression and time series forecasting. Next, I split the data into two parts: a basket of explanatory variables consisting of TD.TO, Scotiabank, BMO, and CIBC, and the target variable, which is the RBC. This setup frames my analysis as a predictive modeling task, where my objective is to use the returns of the other major Canadian banks to forecast the RBC returns. My structure aligns well with my portfolio modeling, risk management, and predictive finance use cases. So to support my resampling and time-based volume analysis, the log return data frame was enhanced by introducing a multi-index that includes a dummy symbol level. This enabled me with the application of resample with the level of date to group and aggregate returns at the monthly level. This step is both elegant and scalable, allowing for cleaner manipulation for panel-like data in a time-aware context. A set of monthly walk-forward dates was then created using the command basket resample with the level of date and the mean computation with the index of -1. This generates a series of monthly checkpoints that serves as a basis for walk-forward modeling. By slicing off the last index by using -1, my model ensures that each training window ends just before the start of the next evaluation period, therefore preventing data leakage between training and testing sets. As a result, a total of 65 walk-forward recalibration days were generated, ranging from January 31st, 2020 to May 31st, 2025. These days are crucial for setting up a dynamic and adaptive modeling pipeline. At each checkpoint, the model will be retrained on data available up to that point and used to predict returns in the following months. This walk-forward framework forms a foundation for running regression, dynamic portfolio allocation, and more advanced online learning models, where continual adaptation to new market conditions is critical for success. Of course, the walk-forward technique right now is not really perfect, but I also modify a newer walk-forward to see the result. So as you see here, is modified walk-forward scatter plots to display the relationship between predicted and actual log returns of RBC across multiple monthly recalibration windows. In each subplot, the x-axis represents their predicted out-of-sample log returns, while the y-axis shows the corresponding actual returns. The title of each subplot includes the recalibration date and the Oscar score for that window, allowing for a quick visual assessment of model performance at each time point. So upon reviewing this plot, it becomes clear to me that the model's performance varies considerably over time. R square values range from very low, around 0.02, as seen on November 30, 2020, to as high as 0.81 on February 28, 2022. High R square values suggest that during certain periods, the model successfully captured short-term code movements between RBC and its p-banks, indicating strong linear relationships. This, in contrast, low R-square scores point to peers where RBC may have more idiosyncratically, possibly due to the company specific event or where short-term market noise and disrupting otherwise stable relationships. These fluctuations indicate that the predictive power of my model is highly context-dependent. A broader view of my model's performance over time is walk forward or square over time. Let us see here. Which tracks the evolution of R-square scores around the walk forward process. The R-square values oscillate dramatically, ranging from near 0 to near 1, suggesting a lack of stability in the linear relationship between RBC and the other banks. Some peers, such as early 2020, late 2021, and the first two quarters of 2023, exhibit relatively high predictability. However, this is counterbalanced by other intervals where the model performs poorly. Such variability is likely a reflection of underlying market-related changes, including macroeconomic shifts like COVID-related volatility, central bank interest rate actions, or company earnings surprises. These patterns suggest that my single linear model may not be sufficient to capture the dynamic nature of market behavior and point toward the potential benefit of dynamic or nonlinear modeling approaches. Overall, the walk-forward framework demonstrates several strengths and limitations. On a positive note, my model achieves high predictive power in certain market conditions, with R-square values occasionally exceeding 0.7. This simplicity makes it easy to interpret and implement, which is advantageous for practical applications. The use of monthly walk-forward validation also mirrors real estate investment strategies, such as monthly portfolio rebalancing. However, my model's limitations are notable. Unfortunately, the predictive power is unstable across time, and the linear structure may underfit during complex or nonlinear market phases. In addition, the small validation window of approximately 10 days could introduce noise and increase the variance of performance estimates. Residual behavior, though implied in my model, warrants further inspection, as errors may not be centered or homoscedastic. Visualizing residuals or adding prediction intervals could provide valuable insights for model refinement. In my conclusion, while my linear walk-forward model provides useful insights during certain market regimes, its inconsistent performance suggests the need for more flexible approaches, incorporating dynamic features. Nonlinear algorithms or regime switching frameworks may enhance predictive stability and robustness in future iterations. So let's conduct further tests on the code integration. My primary purpose of this technique is to analyze the short-term dynamic relationships between daily log terms or candles with 5 banks using pairwise code integration tests. Based on the results from the pairwise angle ranger code integration tests conducted on the daily log returns of them from Jan 2022 to July 2025, I can explore several key insights. The test was applied to every unique pair of banks, assessing whether there exists a statistically significant long-run equilibrium relationship between their return series. The null hypothesis in the code integration test is that no co-integration exists between the two series. A p-value below 0.05 indicates I reject null in favor of the alternative, suggesting co-integration. Remarkably, all 10 bank pairs demonstrated strong co-integration in their log returns, with p-value effectively equal to 0 in all cases. This result is atypical because co-integration is generally observed in price levels rather than in returns, which are usually non-stationary and less likely to share long-term equilibrium. The consistent co-integration across return pairs implies that these Canadian bank stocks not only move together over the long run in levels, but also exhibit synchronized short-term fluctuations after adjusting for differencing through log returns. For example, RBC and TD, as shown in the corresponding plot, clearly exhibit highly correlated movements in their daily log returns. Similarly, BMO and CIBC, two banks that frequently show close valuation and operational similarities, also display tight co-movement. Other highly correlated pairs include Scotiabank and BMO, RBC and CIBC, TD and Scotiabank. This high level of pairwise synchronization in returns suggests strong systematic ties across the sector, likely due to the shared macroeconomic exposure, interest rate sensitivity, regulatory environment, and investor sentiment. While the statistical result is strong, it also calls for deeper inspection. Co-integration in returns can sometimes indicate model misspecification, particularly if the return series are actually stationary, or if the log returns include overlapping influences. For example, identical market or sector shocks. Alternatively, it may point to over-differencing. That is, testing log returns when level data already exhibited co-integration. Another interpretation is that the Canadian banking sector is highly integrated and efficient, with returns adjusting quickly to sector-wide information shocks. From a practical perspective, these findings support the use of pairs trading strategies, co-integration-based portfolio construction, or statistical arbitrage techniques. The high degree of synchronization also means that predictive models for one bank, such as RBC, can benefit substantially from incorporating return information from its peers. In summary, all tested pairs of Canadian bank log returns are co-integrated at a high level of significance. This suggests that even short-term return dynamics among these institutions are not independent, but rather tightly linked. For portfolio managers, risk analysts, or financial modelers, this reinforces the importance of modeling these assets jointly rather than in isolation. However, due to the unusual nature of co-integration in returns, additional tests such as stationary checks with ABF and KPSS and residual diagnosis are warranted to validate the robustness and economic interpretability of these findings. So my analysis involved testing for pairwise co-integration among the log price series of those 5 banks. And this approach is more conventional than testing on log returns. And that's because co-integration theory typically applies to non-stationary series like price levels. So you can see that in nearly every plot, there's strong visual similarity between two log prices, price series. Let me show you here. The plot of RBC and TD display closely aligned trends, both falling in early 2023 and rising sharply through 2024 and 2025. The co-integration test returned a p-value of nearly zero, indicating a statistically significant long-run relationship. Similarly, the BMO and CBC tracked every order quite well across the entire period, especially during recovery phases. This is consistent with the expectations, as both banks often exhibit similar business models and risk profiles. So the plots help reinforce the interpretation of the statistical results. In some cases, the price series appear to be on parallel trajectories with consistent gaps, suggesting stable proportional pricing. In others, the gap fluctuates but ultimately returns to equilibrium, reflecting temporary dislocations driven by news, earnings, or macroeconomic variables. Across the board, there's strong empirical evidence that these banks are not only part of the same sector, but are also tightly bound in price dynamics due to shared economic exposure. From a modeling perspective, these results validate use of multivariate methods such as vector error correction models, VCM, or co-integration-based long-short strategies in pairs trading. Since the lot prices of these banks are co-integrated, deviation between their values could be exploited for statistical arbitrage, assuming mean reversion holds in the future. My findings also justify constructing risk or factor model using linear combination of bank prices, as their long-term dependencies are statistically grounded. In conclusion, my analysis demonstrates that the major banks move in coordinated patterns not only in returns but also in lot prices. The strong co-integration detected across all pairs supports the hypothesis that these institutions are governed by shared fundamentals and systematic drivers. This presents both opportunities and risks for investors, analysts, and modelers who rely on the stability of interbank relationships to forecast behavior or design financial strategies. Now I will use the co-integration to build a basket. The co-integration test results for the lot prices of Canada's big five banks over the period from 2022 to 2035 were summarized in the matrix of p-values using the angle ranger methodology. According to the standard interpretation, as p-value below 0.05 indicates statistical evidence of co-integration, meaning that I can reject the null hypothesis that no co-integration exists between the pair. Conversely, as a p-value greater than or equal to 0.05 suggests no co-integration, and the relationship between the two series is likely non-stationary in the long run. Upon reviewing my results, none of the bank pairs show statistical co-integration at the 5% significance level. The lowest p-value was observed for the pair BMO and Bank of Nova Scotia, which yielded a p-value at 0.14, although this is below some informal threshold used in exploratory analysis. It is still above the conventional cutoff of 0.05. As a result, no bank pair meets the criteria for strong statistical co-integration based on this test. That said, there are several pairs with relatively low p-values that may still suggest economic relatedness or co-movement worth investigating further. These include BMO and Scotiabank with a p-value of 0.14, BMO and TD with 0.26, Scotiabank and CIBC with 0.33. Why not statistically significant under strict hypothesis testing? These values may indicate some level of economic co-integration or long-term alignment in pricing behavior, particularly in the context of spread trading or mean reverting strategies. In those cases, analysts and traders may consider relaxing the significance threshold slightly, for instance, to 10%, when selecting candidates for co-integration-based trading. This approach is especially useful in financial markets where small sample sizes or market frictions can reduce statistical power. Ultimately, while formal integration is not established at the standard 5% level, some of these banks pairs may still have practical use in portfolio construction, cash trading, or other applications that rely on stable long-term relationships. Here, I will conduct multilinear regression for the 5 banks, predicting obviously from TD and Scotiabank. In case that my portfolio has 3 banks, my model summary outlines the performance of this ML model designed to predict the lot price of RBC using the lot prices of TD and Scotiabank as predictors. My model was trained on data spanning from January 1st, 2022 to January 31st, 2024. The adjusted R2 value is 0.4 somewhat, indicating that approximately 42% of the variation in RBC lot prices can be explained by the combined movement of TD and Scotiabank during this period. An adjusted elsewhere of around 42% reflects moderate explanatory power. This suggests that while TD and Scotiabank prices contain meaningful information about RBC pricing behavior, they do not capture the full complexity of RBC dynamics. The model is still capable of identifying general code movements, but falls short of delivering highly precise predictions. My above visual analysis supports this interpretation. The predicted lot price of RBC, represented by orange line, follows the general direction of the actual lot price, shown in blue, over medium-term time windows. However, my model struggles to capture sharper market movements, notably between the third and fourth quarters of 2022. The predicted values remain relatively flat while actual prices rise and fall. A similar pattern occurs in late 2023 when RBC's actual price recovers more quickly than the model anticipates. These discrepancies indicate that the model lacks certain dynamic inputs and may not be accounting for variables unique to RBC. This performance gap may stem from the absence of idiosyncratic factors such as company-specific needs, risk management strategies, capital structure differences, or dividend policies. While TD and Scotiabank share systematic traits with RBC, they cannot fully explain all of this price behavior on their own. Strategically, my model is useful for capturing general sector movement and could serve as a basic hedging tools in portfolio. However, it is not robust enough to function as an accurate tracking portfolio or for short-term return prediction. So for those purposes, more sophisticated models incorporating additional variables or nonlinear methods may be required. Here's my analysis of residual spread and co-iteration for predicting RBC using peer bank block prices. My analysis focuses on modeling RBC's block prices using multiple linear regression approach. My model was trained using data for the same period and to examine whether the predicted RBC price from a linear combination of its peers can produce a stable residual spread, indicating potential co-integration and mean reverting behavior. My example regression produced a spread between actual and predicted block prices of RBC, which was then subjected to ADF test to assess stationarity. The p-value from the example ADF test were approx 0.1337, and the test statistic was negative 2.42. Since the p-value is above the conventional 0.05 threshold, I cannot reject the null hypothesis of a unit root, suggesting that the spread is not statistically stationary in sample. Visually, the in-sample spread plot shows some mean reverting patterns, but with noticeable recycles and persistent deviations around the mean. Although the spread fluctuates around a flat trend line, this lack of stationarity undermines the case for reliable long-term equilibrium. My model was then applied out of sample to predict RBC's lot price from the same basket of bank stocks. The predicted and actual prices diverge consistently over time. The predicted lie underestimates RBC's price movements, especially during upward rallies between mid-2024 and early 2025. This aversions indicates that the overall model, while moderately effective at capturing cold movement in training, fails to generalize well to future peers. The lack of dynamic adjustment or inclusion of time-varying factors likely contributes to this underperformance. The out-of-sample spread, the difference between actual and predicted lot prices of RBC, were also tested for stationarity using the ADF test. The resulting p-values was approx 0.1394 with a test statistic of negative 2.41. Like the in-sample case, this result suggests that the spread remains non-stationary and does not exhibit reliable mean reversion behavior. Visually, the spread trends upward and remains elevated for much of the test period, further confirming the model's instability outside the training window. These results indicate that the chosen ML model does not capture a stable long-run relationship between RBC and the selected P-bands. Although the visual alignment in the training phase appears reasonable, this undermines the use of my model for current duration-based strategies, such as pair trading or statistical arbitrage, where mean reverting spreads are essential. So in my conclusion, the spread between RBC's actual lot price and the price predicted by the linear basket of the four other banks is not stationary with either the training or testing period. My MLR model demonstrates some predictive power but lacks robustness and fails to produce a residual series that satisfy the conditions for mean reversion. Future efforts should explore more dynamic models, such as vector error correction models, regime spatial models, or machine learning techniques that can capture nonlinearities and structural shifts more effectively. Now I will conduct another analysis using log returns between the SVR versus random forest on the RBC. My analysis compares two machine learning models, SVC and random forest, in predicting the daily log returns of RBC using the log returns of the other four major banks. My focus is on evaluating both models' accuracy and their ability to generate stationary residual spreads, which is essential for applications like short-term forecasting and return-based trading strategies. My data includes log returns calculated from daily trusted closing prices spanning January 2022 through July 2025. The trading set covers up to the end of January 2024, while the testing set begins in April 2024. A grid such was used to optimize hyperparameters for the SVR model, while the random forest model used 200 estimators with a maximum depth of line. Both of my models perform well on the training set. My SVR model achieved an R-square value of approx 0.65 and a root mean square error of 0.00585, while my rainforest model outperformed it with an R-square of 0.81 and a lower RMSE of 0.00434. And I can see that, importantly, the ADF test on the training residuals showed p-values close to 0 for both models, indicating that the residuals were stationary and mean reverting during the training period. This suggests that both my models capture stable and predictable relationship within the sample data. In the out-of-sample test period, both of my models maintain relatively strong performance. SVR produced an R-square value of 0.42 and an RMSE of 0.00778, while rainforest had an R-square of 0.43 and a slightly lower RMSE of 0.00769. The residuals from both models remain highly stationary in the test set, with the SVR model showing an ADF test statistics of negative 20.07 and the random forest model showing negative 15.32. These strong negative values and extremely low p-values confirm that the residual spreads continue to exhibit stationarity, which is favorable for return-based modeling. So my prediction plot supports these findings. The actual log returns out obviously are captured with reasonable accuracy by both models. SVR occasionally shows sharper, more reactive movements, while the random forest model produces smoother and slightly more conservative forecasts. Both models align well with the short-term fluctuations, although some of the larger spikes in actual returns remain difficult to predict, which is typical in financial return series. Overall, my analysis demonstrate that the return-based modeling is more effective and robust than burst-level modeling for predicting tasks involving RBC and its peers. Both SVR and random forest produce stable and accurate forecasts of returns, with random forest showing slightly better in sample fit and generalization. The stationarity of residuals further validates the modeling approach and supports the suitability of return forecasting in financial applications such as signal generation, short-term portfolio rebalancing, or machine learning-based trading strategies. So now I would come up with my strategy implementation. My analysis evaluates the daily return performance of Canada 5 largest banks compared to the TSX index, as well as the S&P. Here I will show the plot of the TSX. This is to distinguish between upmarket and downmarket conditions. And my objective is to identify which banks exhibit strong momentum during market rallies and which one provides downside resilience during market declines. So on days when the TSX was rising, all 5 banks outperformed the index. Among them, BMO delivered the most substantial upside, outperforming the TSX by an average of 155%. CIBC and TD follow with notable positive excess returns. This consistent outperformance on TSX up days indicates that these banks, especially BMO, exhibit strong momentum characteristics and tend to amplify gains during bullish sessions. In contrast, during TSX down days, All 5 banks underperformed the index, suggesting Canadian bank stocks are more sensitive to market downturns. BMO had their weakest downside performance, trailing the TSX by 0.133% on average. TD and CIBC also recorded significant performance, reinforcing their higher volatility profiles. RBC were still underperforming, showed the smallest relative drawdown, making it comparatively more stable in declining markets. These dynamics offer guidance for strategy selection. For momentum-driven strategies that aim to capture gains during market rallies, BMO, TD, and CIBC are strong candidates due to their consistent outperformance when TSX rises. On the other hand, for defensive or risk-averse strategies that prioritize capital preservation during market downturns, obviously is the most suitable option. Given its relatively mild underperformance, CIBC represents a balanced profile with meaningful upside and moderate downside, making it potentially attractive for investors seeking on wider exposure. Therefore, the accompanying visualization supports these findings. It highlights how BMO lists in upside excess return relative to TSX blue bars, while all banks, including BMO and TD, experienced steeper losses than the index on down days, red bars, as I showed earlier. This asymmetrical behavior implies that these stocks behave as high beta, momentum-driven assets. As such, investors should carefully align their bank stock selections with their market outlook and risk appetite, favoring BMO and TD in bullish environments and leaning toward RBC or CBCs in more defensive allocations. So here I will conduct weekly outperformance predictions of Canadian banks relative to the S&P 500 using machine learning. The daily test outperformance and underperformance failed to produce any predictions, likely due to high noise in daily data, threshold not being frequently met, or signals are drowned out by short-term volatility. Small daily changes often fall within noise bands and lead to few or no label equal to one case, which hinders training. Then I will implement larger weekly changes that are more likely to surpass thresholds, so the classifier can learn extra patterns and generate meaningful signals. Looking to the right side, my analysis focuses on predicting which Canada's major banks are likely to outperform or underperform the S&P index on a weekly basis using historical data and engineered financial features. The models apply supervised machine learning with random forest classifiers and utilize data from January 2018 to the present, including tickers for the 5 Canadian banks. So to prepare the data set, weekly adjusted closing prices were collected and converted into locked returns. Additional engineered features included a 5-week rolling average return on the momentum proxy, a 10-week volatility, the risk estimate, and a 10-week cumulative return, representing long-term trend strength. These rolling features were computed separately for each ticker. Outperformance and underperformance labels were defined using relative return thresholds against the S&P 500 benchmark. A bank was labeled as an outperformer if its returns exceeded the S&P 500 by at least 0.5% in a given week. It was labeled as an underperformer if its return lagged the S&P 500 by more than 1.5%. These thresholds help the model detect significant deviations in performance rather than minor fluctuations. Random forest classifier were trained separately for the outperform and underperformance classification using the engineered features. The models were applied to the most recent 2 weeks of data for each bank to produce forward-looking predictions. My latest results suggest that Scotiabank is predicted to outperform the S&P 500 in both of the most recent 2 weeks. No banks were flagged for underperformance under the defined threshold. This prediction implies that the Scotiabank currently exhibits strong recent momentum and favorable technical indicators relatively to the S&P 500. Therefore, my machine learning framework offers a simple but powerful tool for weekly momentum screening and risk flagging among Canadian bank stocks. It can be used to support tactical asset allocation, hedge adjustment, or signal generation in a rules-based trading strategy. Regular retraining or validation would further enhance robustness, especially in volatile or changing market conditions. Okay, now I would switch our attention to the feature important analysis in weekly outperformance model. Here I analyze the feature importance results from the random forest classifier used to predict the Canadian bank's weekly outperformance relative to the S&P 500. My model is based on 3 engineered features, like I said earlier. The hypotheses are calculated based on their relative contribution to model decision making. The 5-week average return accounts for approximately 34% of the model's decision power. This suggests that recent short-term return performance is the most influential factor. A bank stock with consistently strong returns over the past 5 weeks is more likely to be flagged by the model as a potential outperformer in the upcoming week. The close behind is the 10-week momentum features, which contributes about 33% to the model. This feature captures the broader trend over a slightly longer time horizon. Its nearly equal importance to the 5-week average return implies that the model values both short-term and medium-term price action when identifying strong candidates. Interestingly, the 10-week volatility feature also holds roughly 33% importance. Lower volatility appears to be positively associated with outperformance, meaning that the model prefers stocks with not only upward trends, but also relative stability. This highlights that the model is not purely chasing high return candidates, but also considers the consistency of those returns. Overall, my models demonstrate a balanced perspective, weighing return-based momentum signals and risk-based volatility nearly equally. This distribution indicates a well-structured and non-redundant feature set. It also suggests that the model tends to favor bank stocks that exhibit a combination of strong recent gains and controlled risk exposure, aligning with momentum strategies that avoid excessive drawdowns. Here I would conduct backtesting random forest prediction on Canadian bank stocks such as S&P 500. My random forest backtest aim to evaluate how well the model could distinguish between Canadian bank stocks that would outperform and underperform the S&P 500 benchmark using engineered weekly features such as the 5-week average returns, 10-week volatility, and 10-week momentum. For the outperformance classification model, The results show an accuracy of 67% and a precision of 50%. This means the model correctly identifies 60% of prediction overall. When it predicted a stock to outperform, it was correct about 52% of the time. The backtest executed 99 body trades based on these outperformer predictions. These trades achieve an average weekly return of 1% compared to the market's 0.4% in the same periods. This leads to a 0.6 percentage point outperformance over the S&P 500, indicating a modest edge in identifying upside momentum. For underperformers, the model had a higher accuracy of 8%, but a much lower precision of 27%. This reflects the challenge of reliably identifying losing trades. A total of 22 sell signals were triggered. These predicted underperformers had an average return of negative 3.1%, while the market in those same weeks averaged negative 1.9%. The difference of negative 1.2 percentage points confirms that the selected stocks underperformed even in the declining market, but not dramatically so. This supports that the model is somewhat capable of identifying downside risk, albeit with limited precision. Looking at cumulative return loss, the outperformer strategy significantly beat the benchmarks, with the equity curve diverging sharply upwards. On the other hand, the underperformer portfolio performed worse than the market, confirming its negative predictive value. However, the low precision on the side of the model suggests results should be interpreted cautiously. Overall, my backtest confirms that the feature set provides meaningful signals, particularly for identifying stocks with potential upside. The model is less reliable for catching underperformers, highlighting room for improvement in classification thresholds of feature expansion. Nonetheless, this setup could form the basis for a dual strategy, overweighting predicted outperformance while treating underperformers more as a volatility or risk flag than a short signal. So here is my evaluation of ensemble model performance for weekly Canadian bank predictions. My analysis compared two classifiers, one for identifying potential outperforming stocks and another for underperformers, based on weekly financial features for Canadian banks relative to S&P 500. My models use an ensemble of rainforest, logistic regression, and SVC to improve robustness. For the outperformance classifier, my model achieved an accuracy of 53% and a precision of 42%. The confusion matrix shows 116 true negatives, 177 false positives, 39 false negatives, and 130 true positives from a total of 307 predictions. While the precision is not exceptionally high, the classifier was profitable. The cumulative returns of stocks predicted to outperform more than double that of the market, indicating strong predictive power in identifying upward trending stocks. The underperformance classifier performed modestly, with an accuracy of 50% and a lower precision of 25%. The confusion matrix for this model shows 201 true negatives, 154 false positives, 45 false negatives, and 62 true positives out of 216 total predictions. Despite the low precision, the classifier serves its purpose in helping to avoid poorly performing stocks. The group of predicted underperformers underperformed the market by 43%, aligning with model expectations. Several factors contributed to the model's effectiveness. The liberal voting mechanism, predicting positive if any of the classifiers agree, increased coverage. The dataset had roughly 35% of positive class instances, offering a good balance between signals and noise. The ensemble model leveraged the strengths of each classifier type, while the three engineered features, 5-week average return, 10-week volatility, and 10-week momentum, were effective for weekly prediction horizons. To further improve model performance, there are several promising strategies. On the feature engineering side, incorporating industry-adjusted returns using sector-specific ETFs like S-278 or adding macroeconomic indicators such as USD, CAD, exchange rates, and interest rates could help contextualize each stock's behavior, including lag returns as inputs may also better capture momentum shifts. From a modeling standpoint, shifting from equal voting to a weighted ensemble based on validation AUC would allow stronger models to carry more influence. Adding models like gradient boosting or XGBoost could also enhance nonlinear pattern detection. Additionally, switching to time series cross-validation would provide a more realistic assessment of out-of-sample generalization. Finally, the strategy logic could be refined. Selecting only the top-end highest probability outperformance could concentrate returns and reduce noise. Filtering prediction by risk matrix like Sharpe ratio and maximum drawdown would improve robustness. Simulating transaction costs would also bring the backtest closer to real-world conditions and stress test the strategy's profitability. So in summary, my ensemble model delivers meaningful predictive power for both long and short strategies on Canadian bank stocks, with room for enhancement through better validation, additional features, and portfolio features. Here's a quick look of the Canadian financial market overview from 2019 to the present. The plots I generated are highly relevant to what I did earlier in my machine learning-based financial modeling work. These charts help me contextualize and validate the behavior of the Canadian bank stocks I use as targets in my models. So to begin with, I previously built a classification model to predict whether Canadian bank stocks would outperform or underperform the S&P 500 on a weekly basis. The price plots I created now provide long-term context for these exact stocks, visually highlighting trends, momentum bursts, and relative performance differences. For instance, RBC clearly outperformed over time, which is consistent with its higher predicted outperformance rate in my model, while Scotiabank lagged behind, validating its weaker profile in the classifier inputs. Next, I included Canadian equity benchmarks, which are more geographically aligned with the Canadian banks compared to the S&P 500. Why I used the S&P 500 as my benchmark earlier, this plot suggests that incorporating domestic indices could help me build more accurate models. Using Canadian benchmark as a reference point would likely reduce bias and improve the explanatory power of my predictive features. I also plotted Canadian bond ETFs such as SPB and SGB, which function as lower risk or near risk-free investment vehicles. These bond trends can act as proxies for macroeconomic conditions or interest rate environments, including their returns or volatilities as macro features in my classification model. Could enhance regime detection and provide better context for the behavior of the bank stocks I'm modeling. Moreover, the long-term stock price visually confirm that my engineered features, such as 5-week average return, 10-week momentum, and 10-week volatility are relevant. The charts reveal clear periods of volatility clustering and sustained price trends, supporting the use of these based features. This gives me better confidence that my model is not just fitting noise, but learning from meaningful microstructure. Lastly, this plot strengthens my ability to interpret model outputs and consider practical investment applications. By comparing behavior of predicted outperformers and underperformers against actual benchmark movement, I can better assess the real-world value of my predictions. This visualization also set a foundation for building more robust portfolio simulation or walk-forward strategies in the future. Overall, these charts tie directly back to my earlier work by reinforcing the importance of my target assets, suggesting ways to improve benchmark selection, supporting feature relevance, and helping me visualize model-informed strategies over time. Here's my efficient frontier analysis for 5 Canadian banks from 2019 to 2024. My analysis applies portfolio theory to assess risk-return trade-offs among the 5 largest Canadian banks. Using historical adjusted close price from 2019 to the end of 2024, I calculated daily returns and analyzed both expected returns and the covariance matrix. A Monte Carlo simulation of 10,000 random portfolios was conducted to visualize the efficient manner of this efficient frontier. The resulting scatter plot represents portfolios by their expected return and volatility standard deviation, color-coded by Sharpe ratio. 2 optimal portfolios were identified. The red stars marks the portfolio with the maximum Sharpe ratio, which indicates the best risk-adjusted return. Its allocation is heavily weighted toward BMO, about 59%, and Scotiabank, about 36%, with minimal exposure to the remaining banks. This portfolio achieves the highest excess return per unit of risk. The blue cross represents the minimum volatility portfolio, which offers the lowest risk exposure. It is also significantly allocated to the BMO, about 62%, and TD, about 23%, suggesting BMO plays a central role in stabilizing return variability. This portfolio would be suitable for more conservative investors prioritizing stability over aggressive returns. The simulation highlights the wide distribution of risk-return profiles, where some portfolios clearly dominate others in terms of Sharpe ratio. The frontier also reinforces the importance of diversification, as the top-performing portfolios blend exposure to multiple banks rather than concentrating on a single stock. My optimization exercise supports practical applications such as asset allocation, risk management, or wealth advisory planning. It offers a framework to quantify trade-offs between return and volatility and provides a foundation for building more advanced strategies, including dynamic portfolio rebalancing or stress testing under various economic scenarios. To enhance my understanding of deep learning for time series data, I developed a recurrent neural network RNN forecasting model as part of my course, CSCI S-89 Deep Learning. That's my other course I took in summer 2025. My goal was to perform 1 day ahead prediction of daily adjusted closing prices for 5 major Canadian banks. My project served as a practical application of RNN techniques on financial time series, which typically exhibit sequential dependencies and temporal patterns suitable for such architectures. I began by downloading adjusted daily closing prices from 2019 to 2024 for the 5 banks. Each time series was normalized based on the training subset and then transformed into supervised learning format using a sliding window, 60 days. This means that my model used the past 60 days of stock prices to predict the next days. I trained a simple RNN with one recurring layer followed by a dense output node. My model was evaluated using MAE and MSE matrix and tested on the most recent 200 days of each stock. The prediction plots for the 4 banks, RBC, TD, CIBC, and Scotiabank show good alignment between predicted and actual prices, especially for the RBC and TD, where the model captured the upward momentum and short-term fluctuations reasonably well. The loss and MAE curves for these tickers indicated smooth convergence within just 5 epochs, with little overhead. However, the performance on BMO were significantly worse, with a high RMSE of 23.77 and MAE of 17-ish. The predicted series for BMO underestimated the recent price surge and failed to capture the trend, possibly due to the model interpreting or sudden price jumps that a simple RNN could not generalize. So my exercise highlighted the strength of RNN in capturing short-term dependency in financial time series, particularly for moderately volatile stocks like TD and CIBC. However, it also revealed limitations in modeling high volatility assets such as BMO, suggesting the need for more sophisticated architectures like LCM or GRU for better handling long-range dependency interruptions. Overall, this RNN forecasting framework helped reinforce concept from the 2 courses actually, the S-89 and the S-278 courses in summer, and provided a realistic benchmark for time series modeling in financial markets. The structure, trend loop, and visualization workflow in my pipeline here serve as a solid foundation for future enhancements such as multi-day forecasting, incorporating exogenous features, or extending to a more advanced neural architectures. Next, I will switch my model application to the LSTM, still with the 1 day ahead forecasting for the Canadian bank stocks. To deepen my understanding of advanced time series modeling, I implemented LSTM long short-term memory networks to perform 1 day ahead price forecasts for financial banks. My work builds upon my prior implementation of simple RNN and was directly inspired by techniques taught in the course CSCI H9 Deep Learning, where I explore various architectures suitable for sequential and temporal data. The primary objective of using LCM in this context was to improve my model's ability to capture long-term dependencies and nonlinear patterns in financial time series data. Compared to traditional RNNs, LCMs are better equipped to handle vanishing gradients and preserve information across longer sequences, making them well suited for stock price forecasting tasks that rely on sub-market memory and trend behaviors. For each stock, I trained an LCM model on the past 60 days of normalized adjusted close prices and use it to forecast the next 200 days of prices, one step at a time. The models were trained using 2 stacked LCM layers with dropout for regularization, followed by a dense output layer. I monitor both the loss and mean absolute error curves to evaluate model convergence and generalization. My results vary across tickers. For example, TD and Scotiabank yielded relatively low MA and RNS's score, indicating strong predictive alignment with actual prices. Visual inspection of their forecast plots confirmed that the model tracked price movements well, especially during trending periods. CIBC show moderate accuracy with smoother predicted curves that follow the general trajectory but missed sharper fluctuations. In contrast, BMO and RBC exhibited higher prediction errors, likely due to more volatile price swings and recent trend shifts not fully captured by the training window. Overall, this experiment validated that LSTM networks can effectively model short-term trends in stock price data, particularly for moderately volatile assets. While the model demonstrated solid performance in predicting directional trends, some lag in price inflection points suggest room for improvement through additional features, longer training histories, or hybrid modeling approaches. This LSTM-based modeling complements my broader work in time series analysis and portfolio optimization by offering a data-driven approach to tactical forecasting. It provides a foundation for future experimentation with sequence-to-sequence architectures, multivariate inputs, and probabilistic forecasting techniques using advanced deep learning tools. Here's my statistical analysis of Canadian bank portfolio returns for this period 2019 to 2025 using the chart error normality test. My analysis evaluated the distribution of data returns for the portfolio of them over this period, and the returns were calculated on a daily basis and equally weighted across all 5 stocks to form a simplified portfolio. So to assess the statistical properties of the portfolio return distribution, the chart error test for normality was applied to the most recent 520 trading days, approximately 2 years of returns in the training set. The test yielded a p-value of effectively 0, which is well below the standard 5% significance threshold. My results provide strong statistical evidence that the portfolio's return distribution deviates from normality. Such deviation may be caused by skewness, excess kurtosis, or both, which are common in financial returns series. The time series plot the daily returns further confirm this, displaying numerous sharp movements and potential outliers, especially during volatile periods such as the COVID-19 shock in 2020 and regional interest rate fluctuation in later years. Given the non-normal nature of returns, risk measures that rely on the normality assumptions, for example, parametric value at risk, should be applied cautiously. Instead, more robust techniques such as historical simulation, conditional value at risk, CVAR, or models that account for habitats and asymmetry, example, GOSH or EBT, may be better suited for estimating downside risk in this portfolio. So, now I would need to estimate and visualize historical value at risk, the RR that I mentioned earlier, and the conditional value at risk, CVAR, that I have just mentioned, for a Canadian bank portfolio from 2019 to 2025. My analysis evaluates downside risk exposure of a Canadian bank equity portfolio using 2 commonly risk matrix, value at risk and conditional value at risk. My portfolio is equally weighted across 5 banks based on the test returns from March to July 2025. The 95% of historical DAR estimate that under typical conditions, the portfolio would not lose more than approximately 1.2% of its value on 95 out of 100 days. However, on the worst 5% of days, actual losses could be greater. This tail behavior is better captured by the CVAR metric, which estimates the average loss on those worst case days. The 95% of CVAR suggests that on average, losses during those extreme cases were closer to 3% of portfolio value. My histogram supports the interpretation. The bulk of returns lie to the right of the VAR threshold, marked in blue, with a heavy left tail where loss severity increases. The red dashed line marking CVAR lies further left, indicating that average losses on the worst days are more severe than what VAR alone implies. Overall, my portfolio exhibits significant left tail risk, while VAR provides a boundary of expected daily losses under normal conditions. CVAR provides a more comprehensive view of potential exposure during adverse market scenarios. This suggests my need for additional buffers or hedging strategies when managing such portfolios during volatile market periods. Therefore, there will be additional need in detecting sharp drops and predicting recovery for Canadian bank stocks from 2019 to 2025 using random forest and logistic regression. So that means there will be analysis of risk and hedging. One of the technical risk hedging would be the beta neutral hedging analysis for Canadian bank stocks using Ledoy-Wolf residual correlation. Here are my results from that, which reveal meaningful insights about portfolio diversification after accounting for market-wide exposure. My plot shows the cumulative residual returns for the 5 major banks after removing their sensitivity to the TSX and composite index through linear regression. The residual return path exhibit more divergence than raw price movements, indicating that much of the original curve movement was driven by market beta rather than firm-specific behavior. The residual correlation matrix estimated using the Ledoy-Wolf shrinkage estimator quantifies the degree of pairwise curve movement remaining in the idiosyncratic components of each stock. Most values fall in the range of 0.3 and 0.5, with the average pairwise residual correlation calculated at approximately 0.4062. This level of residual correlation is significantly lower than the unhedged average correlation, which was around 0.74 in the earlier raw return correlation matrix, confirming that beta hedging was effectively removed share exposure to the broader Canadian equity market. However, the remaining correlation above zero implies that bank-specific or sector-specific risks still drive some curve movements among the stocks, likely due to the shared business models, economic sensitivity, or regulatory influences. Overall, my analysis supports the use of beta neutral hedging to isolate idiosyncratic return sources. While not fully independent, the residuals offer greater diversification and potential than raw returns. For a portfolio manager or risk analyst, this residual analysis of mine provides a clear lens to assess stock-specific behavior and optimize for uncorrelated alpha. Here is my other techniques of risk and hedging using the beta beta neutral hedging analysis and market sector neutral hedging analysis. As well as beta hash P&L calculation for Canadian bank stocks against market index. For now, I will skip that part, and I would come straight forward to the volatility trade entry exit and LCM forecasting. So as discussed earlier, all 5 stocks exhibit strong imposition autocorrelation at lower lags that slowly decays toward zero. The autocorrelation pattern suggests that prices are highly serially correlated, particularly over shorter lags, which is common in trending on a stationary financial time series. Some banks like the Scotiabank and the CIBC also show weak periodicity or oscillation in autocorrelation values, which may reflect cyclic patterns or seasonality in their price dynamics. All 5 prices series try to reject the null hypothesis of the ADF test, indicating that they are non-stationary in their original form. This suggests that differencing or transformation is required before applying a remark, GOSH, or LCM-based forecasting model. So now here's the crucial part that I will conduct the forecasting Canadian bank stocks prices using LCM carefully for this period. My long short-term memory forecasting analysis for the 5 major banks over this period reveals varying levels of predictive accuracy and pattern capture across institutions. My model was trained on 80% of historical closing prices and tested on the remaining 20% with prediction performance evaluated using root mean square error. Among the 5 banks, Scotiabank achieved the most accurate results with a remarkably low RMSE of 1, followed closely by CIBC at 1.36. These outcomes suggest highly predictable price behavior in the testing window, with the model successfully tracking the validation data and adapting to trend shifts in price rebounds. RBC also outperformed well with an RMSE of 2.67, indicating decent model generalization. In contrast, TD and BMO produced higher RMSE values of 3.49 and 3.34 respectively. These deviations were especially notable during periods of rapid price appreciation or heightened volatility, where the model struggled to keep pace with sharp movements. Visually, the LCM predictions for Scotiabank and CIBC align closely with the actual validation data, showing minimal divergence. The forecasted lines almost overlap true prices, reflecting strong learning of temporal dependencies. In contrast, TD and BMO forecast slightly lag behind the actual during upward trends, likely due to the univariate model inability to capture external catalysts such as interest rate changes, policy shifts, or sector-wide shocks. While the model captures general direction, it underestimates price momentum during peak periods. All 5 stocks display similar macro patterns. A steep decline during the early 2020 COVID-19 shock, a recovery phase across 2021-2022, and strong upward price action into 2024 and 2025. My LCM architecture, although designed to capture sequence-based patterns, showed very success in adapting to these longer-term structural shifts. From a trading perspective, stocks like Scotiabank and CIBC, with strong forecast alignment and low RMSE, may offer useful signals for short-term entry-exit strategies. especially when combined with volatility filters or trend indicators. The outputs are TD and BMO, while directionally reasonable, warrant caution for trade execution due to noisier predictions. In terms of volatility tracking, the residual errors serve as a proxy for detecting unpredictable zones or shifts in regime. While the results are promising, there are clear limitations in using a univariate LCM model. The exclusion of macroeconomic and sector-level features restricts my model ability to generalize under unusual conditions. Future improvements could include the incorporation of exogenous variables such as central bank rates or prices or VIX levels. Furthermore, experimenting with bidirectional LCM or attention mechanisms might enhance long-term pattern recognition. Lastly, adopting walk-forward retraining would allow the model to adapt more fluidly to evolving market conditions. Overall, my LCM models offer strong foundations for time series forecasting in Canadian banking equities, particularly when complemented by additional data sources and model enhancements tailored for financial time series, volatility, and ratio shifts. Now, here's the gold question: buy or sell? My trading simulation using a simple 50-day moving average crossover strategy across the 5 major Canadian banks, RBC, TD, Scotiabank, BMO, and CIBC from 2019 and 2025, reveals several patterns in performance and trade behavior as follows. There are signal effectiveness and frequency. Each bank generated a reasonable number of entry and exit signals over the period. The buy or sell logic, buying when price crosses above the 50-day moving average and selling when it falls below, trigger a mix of short and medium-term trades. The signals appear relatively frequent during volatile periods, especially during the 2020 and 2021 COVID drawdown and recovery. So about the trade profitability and cumulative P&L. Royal Bank showed strong cumulative P&L growth with consistent trend following behavior. Despite some losses around the COVID crash, its later trades aligned well with upward momentum, leading to a cumulative gain exceeding $500. TD also achieved stable gains with moderate drawdowns. Its cumulative P&L curve showed a significant dip during the 2020 crash, but recovered steadily afterward. Scotiabank performed well overall, although with some larger drawdowns. The strategy effectiveness depended on capturing extended rallies, which Scotiabank had during 2021 and 2024 until 2025. BMO experienced the largest drawdown among all 5, with a steep early loss affecting cumulative returns. While it recovered partially in the later half of the period, the strategy showed vulnerability to false signals in choppy markets. CIBC produced modest profits. Its cumulative P&L reflected multiple up and down trades, indicating it may be more susceptible to noise under 50-day MA strategy, possibly requiring a longer smoothing window. So regarding the strategy limitation in market context, my strategy assumes equal side trades and no transaction costs or slippage. As seen with BMO and CIBC, we saw during sideways markets result in reduced profitability. The fixed moving average period may not adapt well to shifts in volatility and trend strength. Regarding the trend capture and risk exposure, overall, my strategy works well in trending environments. Stocks like RBC and TD, which demonstrated prolonged bullish movements, were rewarded by the strategy. Meanwhile, names with more erratic or mean reverting price action, for example, the CIBC, yielded lower or inconsistent profits. In my conclusion, the 50-day moving average crossover strategy is moderately effective across Canadian bank stocks in a long-only context. To improve robustness, enhancements such as volatility filters, adaptive moving averages, or confirmation signals, for example, volume or RSI thresholds, could help reduce false positives and increase risk-adjusted performance. Now I will switch to more advanced technique, which is the reinforcement learning. So based on the visualization and logs from my deep reinforcement learning portfolio optimization results over 3 periods of using 5 Canadian bank stocks, here's structural analysis. First, in this deep reinforcement learning experience, I evaluated the performance of my portfolio optimization model across 3 training episodes using 5 Canadian bank stocks. The results show consistent stability in my final portfolio values, which hover around $10,200 after each episode. While the model maintained profitability, I observed a noticeable increase in maximum drawdown, which rose from 1,344 before training to 1,808 by the third episode. This suggests that my agent took on greater volatility and risk exposure in pursuit of returns. Additionally, the mean portfolio value showed a modest decline across episodes, indicating that the model may have started to overfit or engage in slightly more aggressive trading behaviors without meaningful improvements in returns. Looking at the final portfolio allocation across episodes, I noticed a clear trend of decreasing cash allocation. Before training, the model held roughly 32% in cash, but by episode 2, this had dropped to approximately 12%. This implies that the agent gained more confidence in being fully invested in the market. Over time, the model also evolved from an even but somewhat random allocation to a more structured and balanced portfolio. By the final episode, weights for each stock converge around 17 and 18%, reflecting a learned strategy that spread exposure evenly. Slight preferences emerged for Scotiabank and BMO, which received marginally higher weights. This could indicate that the model detected favorable patterns in their return dynamics. Throughout training, the evolution of portfolio weights over time suggested healthy convergence. In both episode 0 and 1, I observed that weights stabilized after approximately 50 time steps. The allocation to cash gradually decreased, while the allocation to the bank stocks moved toward an equal weighted distribution. Importantly, I did not observe erratic behavior, weight oscillation, or collapse, which confirms that the trending dynamics were stable. Despite this, there are weaknesses in the results. The most significant concern was the rising drawdown over episodes, which suggests that the agent, while reducing cash holdings, began to tolerate greater volatility in such returns. Additionally, the gains in final portfolio value plateau despite further trending. This could be a result of overly strong regularization, underfitting, or simply a local optimum where model favor stability over aggressive growth. To improve the model, I plan to enhance the reward function by incorporating risk-adjusted performance metrics such as Sharpe or Sortino ratio. This will allow the agent to balance reward with volatility controls. I'm also considering adding an explicit penalty or excessive drawdowns to curb risk-taking behavior. Training over a longer horizon or increasing the number of episodes beyond the 3 may allow the policy network to channelize better and uncover more profitable strategies. Lastly, integrating macroeconomic indicators such as interest rates or inflation data could provide additional signals to guide the agent's decision in different directions. In my conclusions, my reinforcement learning model successfully transitioned from a conservative allocation with heavy cash holdings to a fully invested strategy that balances exposure across the 5 Canadian bank stocks. My portfolio achieved stable, albeit modest, improvements while gradually assuming more risk. The next phase of refinement will focus on managing this risk-return trade-off more effectively by enhancing the learning signal and incorporating broader contextual information. Based on the final test evaluation of my reinforcement learning, agent using Canadian bank stocks, I observed clear patterns of growth and stability across 3 comparative strategies: the reinforcement learning agent, an equity-weighted portfolio, and a secured cash-only portfolio. All 3 strategies began with an initial value of $10,000, and I tracked their portfolio values around the test period. By the end of the test, my reinforcement learning agent's portfolio value reached approximately $13,114 each. This was slightly higher than the equity-weighted strategy, which ended at $13,071 each. The secure portfolio, which remained entirely in cash, grew modestly to $10,264 each. Due to the low but steady interest rate applied daily. The similar performance between the reinforcement learning and equity-weighted portfolio suggests that my trend policy closely tracked the broad market trend and possibly run to mimic a diversified exposure patterns that reduce risk and ensure steady growth. The performance gap between reinforcement learning and equity-weighted portfolio was small, but my reinforcement learning strategy edged ahead by a slight margin. This suggests that my model may have optimized allocation just enough to exploit small inefficiency or advantageous timing in specific asset movements. However, the difference was not dramatic, which could be due to the relatively short training duration, modest number of episodes, or the nature of the Canadian bank stocks, which tend to move in correlated patterns and limit the space for strong alpha generation. Interestingly, the drawdown analysis returned 0 for all 3 strategies. This suggests that none of the portfolios experienced a significant peak to draw deadline, implying steady growth during the testing window. While this is ideal from a risk management standpoint, it may also indicate that the test period was relatively favorable for bank stocks and did not include major shocks or market volatility. In more turbulent market conditions, I expect drawdown to emerge, and that will better test the robustness of the reinforcement learning strategy compared to the benchmarks. Overall, I'm quite satisfied with the result. My agent performed on par with a well-diversified equity-weighted strategy while slightly outperforming it. It successfully maintained a stable allocation, avoided excessive risk-taking, and matched the upward trend of its underlying assets. To further improve the strategy, I could experiment with different reward functions, such as using a Sharpe ratio or penalizing variance to make the model more responsive to downside risk. I could also explore training with a broader set of assets or over longer periods to observe how well the agent generalized in less stable market environments. So my project provided a comprehensive exploration of forecasting, classification, optimization techniques applied to Canadian financial markets, um, specifically focusing on five major Canadian bank stocks. By combining traditional financial analytics with modern machine learning, deep learning, reinforcement learning approaches from both courses, CSCI S-278 applied quantitative finance and machine learning, where I got the main materials, and CSCI S 89 deep learning, where I got the supporting elements with RNN. I was able to develop actionable models for both short-term prediction and long-term investment strategies. The most impactful extension came from implementing a deep reinforcement learning agent for dynamic portfolio allocation. I constructed an end-to-end policy network using TensorFlow 1.x, trained it with over several episodes, and benchmarked it against equity-weighted and cash-only portfolios. Across validation test set, the reinforcement learning agent consistently matched or slightly outperformed the equity-weighted strategy, while significantly outperforming the secure cash-only strategies. More importantly, the reinforcement learning agent demonstrated intelligent weight adjustments, shifting exposure away from cash and allocating more evenly across the stocks over time while maintaining portfolio stability. Although the performance gains were modest, my model avoided collapse and exhibited low drawdown during test episodes, indicating strong baseline behavior and conversions. Using regression models such as SVR and random forest, I initially analyzed price level and return-based relationships between Canadian banks, evaluating stationarity though through ADF tests to assess the co-integration potential. However, these models struggle with generalization and drift in out-sample data, leading me to shift focus toward return-based classification frameworks for outperformance and underperformance prediction relative to the S&P 500. The weekly classifier, enhanced with momentum and volatility features, successfully identify outperformers like Scotiabank with superior cumulative returns, which validates the potential of ensemble methods in momentum investing. The reinforcement learning implementation added a key optimization layer to my project, moving beyond static or rule-based asset selection into adaptive, policy-driven allocation. It reinforced the strengths of deep learning in financial modeling, especially when aligned with real-world trading constraints like transaction costs and rebalancing penalties. While the agent's learning horizon and learning architecture could be expanded in future work, this experiment validated the feasibility of applying deep reinforcement learning to real market data in a risk-aware setting. In parallel, I applied time series deep learning techniques like RNN and LSTMs to develop one-day ahead forecast models. These models demonstrated varying levels of accuracy, with LSTMs outperforming simple RNNs in capturing nonlinear dynamics and medium-term patterns. Models for the TD and Scotiabank achieved low forecast error, reinforcing the feasibility of neural networks for financial prediction when carefully tuned and regularized. To mitigate market-wide exposure and isolate idiosyncratic risk, I developed beta-neutral and sector-neutral hedging frameworks using residual correlation analysis. These methods reduce pairwise correlation from 0.74 raw returns to 0.4 up to 0.49 residuals, validating their effectiveness in risk diversification. In parallel, I implemented a moving average crossover trading strategy, which generated buy-sell signals and cumulative P&L for each bank. Royal Bank and TD stood out with the most stable and profitable trade curves, whereas others like BMO revealed vulnerabilities during volatile periods. Finally, I conducted portfolio optimization using Monte Carlo simulation and Sharper ratio maximization. BMO.TO consistently emerged in the max, sharp, and mean volatility portfolios, reinforcing its strong return risk trade-off. This holistic integration of classification, forecasting, trading simulation, and risk optimization provided a multi-dimensional understanding of Canadian bank equity behavior. BMO consistently appear in both the maximum sharp and minimum volatility portfolios, showing strong return risk trade-offs during the historical peer analysis. Together, my approaches provided a multi-dimensional view of Canadian bank equity behavior, integrating econometrics, machine learning, deep learning, and reinforcement learning. My project not only reinforced my understanding of time series modeling from the CSCI S-278 deep learning course, but also helped me to develop a practical pipeline that can inform trading strategies, risk assessments, and data-driven investment decisions. So in closing, my project unified forecasting, classification, and portfolio optimization under a single research framework. It deepened my understanding of time series modeling and gave me practical experience in deploying machine learning, deep learning techniques across diverse financial across the diverse financial tasks. So in future iteration, I plan to explore macroeconomic conditioning, regime switching models, and multi-agent reinforcement learning to further enhance adaptability and risk-aware allocation strategies in complex markets. My future work could extend into regime switching models, macroeconomic factor integration, or reinforcement learning, another kind, for dynamic asset allocation. So that is all my presentation today. Thank you for listening.